Hi everyone, James here. The Bank of England just became the first major central bank to officially raise interest rates since the start of the pandemic, with an increase in the base rate to 0.25%. This is a direct response to inflation hitting 5.1%, the highest it's been for more than a decade. The double whammy of inflation and the hike in the interest rates are going to have ramifications for the UK property market. In this video, I'm going to break them down, talk about what it can mean in the short and the long term, and give you some options for what you can do about it. So, quickly on inflation. We have seen a massive spike this year, with inflation as recently as February 2021 being at 0.7%, but then growing throughout the year to 4.6% in November and now 5.1% in December, despite expectations that it would hit 4.7%. This essentially means that the cost of everyday items is getting more expensive. The Bank of England has stepped in and increased the base rate because it's going to make everyone's lives more difficult if this trend continues and things continue to get more expensive. The idea is that if interest rates are higher, people are going to be more encouraged to save money than spend money, which should bring prices back to normal. The raise came as a surprise. There was widespread opinion that interest rates would stay low because of the Omicron wave that we are seeing here in the UK, with cases potentially hitting 1 million per day by the end of December. 1 million cases per day is even more insane when you remember that the UK has a population of just over 57 million. Even though Omicron symptoms are relatively mild so far, and hospitalisation rates are falling in South Africa, which is considered to be the variant's epicentre, the Bank of England has said they had to respond immediately because the warning signs are of continuing inflationary pressures and that inflation is likely to be 3 times their target by April for a total of 6%. The bank is effectively saying Omicron doesn't matter, the softening housing and stock market doesn't matter, the idea that inflation is transitory is wrong. Right now inflation is about to get away from us and we need to address it now before it's too late. The interest rate rise is a relatively small increase, but it's unlikely to be the only one, and it's more likely that this is just the beginning. We are going to see more and more of these increases happening over the year, with the Office of Budget Responsibility predicting that rates could hit 3.5% by 2023. So what impact is this going to have on property in the short and the long term? The main areas we need to look at to answer this are property prices and mortgages. The effect on house prices is really going to depend on the size and the timing of these rate increases, which could cause downward pressure on the market, versus how much the stock shortage is going to cause upward pressure on the market. Despite softening in prices in October and November, the average price is still going 10.2% this year. Despite the interest rate rise being small, those on tracker and variable rate mortgages are going to see their repayments shoot up by hundreds of pounds a year. This is potentially going to scare off a large group of first-time buyers who don't know what it's like to see a meaningful rise in interest rates. More on that in a minute. It seems likely the other factors in the housing market, such as the stock shortage, increasing wages, and the fact that many have been able to increase their savings hugely whilst in lockdown, will continue to keep strong upward pressure on property prices. The rate rises might slow house price growth in areas where affordability is already stretched, such as London, where it can take someone on average wage 16 years to set aside enough money for a 20% deposit for a typical first-time purchase. However, with such a low rise as 0.15%, there is unlikely to be a significant effect on prices when this is weighed against the other factors putting upward pressure on the property market. The real answer will come in the future, and if future rises in the interest rate come too soon or too fast, the housing market could take a major hit. So that's relatively good news for house prices. What about mortgages? Well, for many people, this will be where the bad news kicks in. There are 3 types of mortgages we need to look at: trackers, variable, and fixed rate. With tracker or variable rate mortgages, these can change whenever the banks decide to change them, and subject to a short notice period, you'll probably start paying more straight away. If you're on a tracker rate that follows the base rate, you can expect increased mortgage payments now. People on standard variable rates will follow soon after. There will probably be people on higher rates by the time I publish this video, and major lenders, including Nationwide, Santander and the Mortgage Works, have already made announcements about their plans or their intentions to reveal their plans soon. Of course, depending on the size of the mortgage and how much you borrowed, 0.15% might not seem like a huge amount extra to be paying every month. However, with inflation forcing everyone to keep a closer eye on their budget and future interest rate increases on the horizon, now would be a good time to switch to a long-term fixed rate mortgage if you can. That's because those on fixed rate mortgages aren't affected by the interest rate rise. In fact, more than 3/4 of homeowners are locked into fixed rate deals, so will be unaffected for now. Their mortgages aren't going to change. People coming to the end of their fixed term should contact their mortgage brokers as soon as possible. If your term expires in the next few months, depending on the lender, your broker should be able to switch you early and reserve you today's rates before any future increases kick in. If you're thinking you've already missed it, so there's no rush now, bear in mind there are almost certainly going to be further increases in the future, so it's worth locking in whilst we are at 0.25%, because it might not be long before we go up to 0.5% or even more, so it's definitely worth having a look as soon as you can. Despite all the fuss about the interest rate hike, mortgage rates are still historically low. If you're a buy-to-let investor and this raise in rates has caused a problem for you, the chances are you don't have enough margin in your property and you need to review your strategy. Finally, there is a counter-argument that the Bank of England has been a bit premature. If the Omicron variant and other variants lead to another full lockdown, then England could go back into recession and the Bank of England will have to reverse this again, even though the change is relatively small. Time will tell. Thanks so much for watching the video. If you found this helpful, please consider sharing, subscribing and hitting the like button, and I'll see you in the next one.